Hi everyone, this is a video on investing in global shares versus investing in Australian shares. This is part of a series of educational videos for private investors like you on topics that arise in managing their investments and growing their wealth for their family's future. So as I said, global shares versus Australian shares. Now, let's bring out the issues in an example. So Safi is thinking about how to allocate her wealth across different asset classes. Australian shares, global shares, real estate, fixed income, meaning bonds and notes, private equity, infrastructure, cash. And Safi has a self-managed super fund in which she has quite a lot of Australian shares, companies listed on the Australian stock market, BHP shares, CSL shares, National Australia Bank, JB Hi-Fi, etc. But what she doesn't have is the shares of global companies listed on global stock exchanges. So she doesn't have the Toyotas and Googles and Citibanks and Boeings, which would be listed on the New York Stock Exchange, the London Stock Exchange, the Tokyo Stock Exchange, and let alone exchanges in Mumbai or Shanghai or Hong Kong or Frankfurt, etc. But Safi can see that savvy Australian investors do have big allocations to global shares, and she can see that in a couple of ways. First of all, if we look at the asset allocation in the pre-mixed options of Australian Super, the largest industry fund in Australia, the balanced fund, which in most of the $180 billion invested in Australian Super is in the balanced fund, 22% of the balanced fund is allocated to Australian shares, and 34% is allocated to global shares. If we go to the right, to the high growth fund, which is higher risk and higher return, 28% allocated to Australian shares, but a whopping 44% allocated to global shares. Now, there's another way that Safi can see that savvy Australian investors are allocating money to global shares, and that's in an aggregate sense. If we look across all Australian investors at how much money they've invested in global shares, that historically has been quite a lot less than the amount that global investors have invested in Australian shares. But so much money has poured out of Australia into global shares, as savvy investors have put more and more into global shares, that since 2013, the amount of money invested by Australian shares into global shares exceeds the amount of money invested by global investors into Australian shares, and now that excess amounts to 8% of GDP. So it's really quite something. So Safi's now thinking, okay, let me weigh up the advantages of investing in global shares versus investing in Australian shares. And in terms of the advantages of global shares, she's really thinking about two things. One is sector diversification, and the other is exposure to falls in the Aussie dollar. Now, if we look at this slide, we can see something about sector diversification in Australia and really the lack of sector diversification. This is just showing how much of the Australian Stock Exchange is invested in financials, which is principally banks, and into resources, meaning mining companies. And we're looking here decade by decade, and we can see essentially in every decade, at least 50% of the value of the stock market is in just two sectors, financial and resources. Well, what about all the other sectors? So what about investments in transport or in retail, or especially in pharmaceuticals and healthcare, or in manufacturing or in tech? Now, those are much bigger parts of the total share market in global shares. And so to get that sector diversification, which is so important for investors, remember that diversification is something for nothing. It's lower risk for the same return. So it's very important. To get that sector diversification, Australian investors need to go to global shares. That's the first thing. The second thing that Safi's thinking about is protection against a fall in the Aussie dollar. So let's have a look at an example on that. Let's say that Safi owned a share on the New York Stock Exchange, which is worth $100 when the Aussie dollar's at 80 US cents, then $100 converts to 125 Aussie dollars. If the Aussie dollar was to fall from 80 US cents down to 60 US cents, then that $100 share would still be worth $100 listed on the New York Stock Exchange, but the $100 would translate at an exchange rate of 60 cents to 167 Aussie dollars. So from Safi's perspective, what would happen when the Aussie dollar goes down is that her spending power on global goods, like imported cars, like foreign holidays, will have gone down. That's bad. But the Aussie dollar value of her global assets, of her global shares, will have gone up, which is good. So investing in global shares is a natural hedge against a fall in the Aussie dollar. And Safi can remember the Aussie dollar falling to 48 cents in 2001. And so she's not thinking it's already fallen, it can't go down anymore. That's simply not right. So Safi's now thinking, well, if people invest so much in Australian shares as well, what's good about Australian shares? And here she's thinking especially about tax. And this is franking credits. And I should just point out that franking credits, dividend imputation, corporate tax credits, those three things are the same thing. Franking credits, dividend imputation, corporate tax credits, they have different names, but they're the same thing. It seems like everything in finance has to have three names. Think, for instance, of shares and stocks and equities. Those are three things that are just the same thing with different names. In any case, when Australian companies pay corporate tax, that creates corporate tax credits. And then when they pay cash out to their shareholders as dividends, corporate tax credits are attached to those dividends. And Australian shareholders can use those. But foreign investors in Australian shares can't use those corporate tax credits. And it's also true that Australian investors in foreign shares don't receive any corporate tax credits. So there's something unique about Australian investors investing in Australian shares. Dividend imputation is peculiarly Australian, and it really creates an advantage for Australian investors investing in Australian shares. So now Safi's weighing up global shares, the advantages of sector diversification and protection against the Aussie dollar falling, versus Aussie shares, the tax advantages. And in the end, she decides, I'm going to invest 30% of my money into global shares. Such are the advantages of investing in global shares. But now she faces the issue of how to implement that decision. Is she going to have a brokerage account in her self-managed super fund and use that to invest directly in global shares? Alternatively, is she going to use a managed fund, or she could use an exchange-traded fund, or she could use an industry fund to achieve implementation of her decision to invest in global shares? There's another choice she has to make. Am I going to put those shares into my superannuation fund, or should I put them into my family trust if she has a family trust? Now, all of those kinds of decisions and many more are fully discussed and explained in my investments course, which is called Finance Education for Investors. It's a comprehensive course on personal investing. It starts from the beginning, so no prior knowledge is needed, but it treats all the important topics in depth. It's not mathematical, but it gives investors the investment philosophy, the knowledge, the processes to be empowered in their investing and to get to better outcomes. It's education, not financial advice. This video runs for 8 or 9 minutes, but that course runs for 22 hours. So imagine how much you'll learn if you take your place on that course. In any case, I hope you've enjoyed this video and the rest in this series.